I'm a technologist, a nerd, a geek, and I've had a successful tech career. I've had a successful technology exit. And during that process, what I found was as a data scientist, we gather data and we use it to accelerate businesses. And what I was finding it was that because I was living in Taxifornia and paying 50% tax as a technologist, whenever I used real estate to further my income, I ended up much far further ahead than I did with technology. And it was even more true when I used cutting edge technology to buy real estate. I had an incredible advantage. So you can use technology in a technology company and it works really well. But the problem is there's all these brilliant people like Yale that are trying to catch up with you. So you only get like a 6-month or 12-month advantage. But when we use technology in real estate, we get to keep that advantage for a significant amount of time. So over a decade, I did this very slowly. I transitioned out of technology and into real estate, opened 2 different companies. The first one, Grocapitus, is focused on both buying and building multifamily. So apartments, we have about 4,800 units with 800 current investors and about $1 billion in portfolio value. The second one, UGrow, focuses on a new revolution in the US for multifamily real estate called build to rent. That's where you don't build apartments, but you build low density, single family or townhome product, and you build it from the very beginning with the goal of renting it, not for people, owner occupiers to live in it. So 2 different companies. From one perspective. So I think that there's many different ways in which technology can be used. One of them, of course, is one that you're very familiar with, and that is tokenization to accelerate, equity growth and liquidity. So we'll obviously talk about that. But there's 3 other pieces that my company uses that I'm known for. So one is real estate analytics, and we can jump into that. A lot of people say we use real estate analytics. I think that that's wrong. What they're really doing is using some basic data to make sure they're investing in a good place. Analytics and big data are a completely different concept. Other than my company, I'm actually yet to find one other true use of analytics in real estate. Now, there are obviously companies that sell analytics and they're hats off. They're amazing. They're way better than I am. But I'm talking about end users of analytics. That's very rare in the real estate industry. So that's one way in which I use technology. Tokenization, which we'll talk about, is a second. And the third one is modular construction, because currently everything in the United States is built on site. That's incredibly inefficient to go out and basically go to a site and build there. And so what I do with some of my newer projects is that I build them off-site, meaning what I do is I build the entire property in a factory, in a controlled environment, no snow, no rain, much stronger, and then basically assemble it on site. So that's the third way in which we use technology. The fourth way, which I'm well known for, there's about 24 podcasts that I've done on it, is the use of offshoring or outsourcing in real estate. So I have a team of 19 full-time employees in the Philippines, and we use these employees for several thousand different tasks and several hundred different projects to accelerate our business. So 4 different ways to use technology. We haven't implemented tokenization yet. As you know, this is a brand new technology that's really getting to the tipping point. So we're close to tipping point for that technology. But the other 3, yes, I've implemented all 3 of these. Modular, I've so far only implemented modular once, but I'm building a factory in the San Antonio, Austin corridor so that I can implement it for all of my projects. We use, property technology. One of the key ways in which, property technology can be used is to raise equity from across the United States, right? So what the traditional model was, you would be a builder in the San Francisco Bay Area. Everybody that you would know would be in the San Francisco Bay Area. Your investors would be local, and you'd be basically just working with those people, taking their money and building buildings. Today, there's the concept of crowdfunding portals where investors are all over the United States, and in the case of tokenization, all over the world. And so if you build a digital infrastructure and a brand infrastructure that allows you to bring those people together, give them the confidence to invest in your projects, even though they live 3,000 or 10,000 miles away from you, that's a very big use of technology. So in my case, I have a 14-person full-time marketing team whose job it is to build that digital infrastructure and to build that digital brand that makes people comfortable cutting me, $250,000 checks for my projects, so that I can build these very large projects. Some of my projects are between $80 and $130 million. And the vast majority of my investors have never met with me. I know them because I sometimes see them on Zoom or have conversations with them, but they don't live in the San Francisco Bay Area like I do. They live somewhere else in the United States. We currently don't accept money from people outside the US, and I'm hoping tokenization will fix that. But with these investors, they're all over the United States, and technology has allowed us to connect with them through a series of webinars. We do 26 webinars a year, and we have about roughly 26,000 people that watch these webinars. So about
Wow.
1,000 people per webinar. And so by creating that credibility over years, we've gotten people to the point where they're investing millions of dollars in our projects. So let's start with inflation. The first way in which we're using technology with inflation is to truly understand what is the track record of inflation in the United States. Most people are simply looking at inflation today. So there's two groups of people, some who are saying, oh my God, we're going to have inflation for the next 10 years, simply because they feel like saying that. And then there's people who are like, oh yeah, inflation is going to be gone in a few months, because most of the time we don't have inflation. So what we've done is we've actually gone back and looked at the data for the last 61 years in terms of how long does inflation stay in the United States. And the short answer is the Federal Reserve, our banking system, has used interest rate increases 9 times in the last 61 years. That's what the data tells us, 9 times. And in all 9 cases, they killed inflation, right? So inflation in the United States, in a developed economy, is a transitory, process. And it wasn't as short as we would all have liked it to be. I would have hoped that it would be gone by now, but it isn't. But what we're doing now with the interest rates will kill inflation. By definition, the US economy is unlikely to have high inflation because we are a very developed economy. We have fantastic supply chain capabilities, not just, from one country, but from dozens of different countries. We produce our own oil, we produce our own gas. What data tells us is that it's extremely likely that the Federal Reserve will kill inflation in the United States in the next 6 months. So all of the moves that we make, and it might take them 12 months instead of 6 months. So all the moves we make is based on that data, right? Now, the data tells us something else, which is not so good news. Of the 9 times that the Federal Reserve successfully killed inflation in the US, 8 times the US economy went into recession. 8 out of 9. So while the Fed appears to be really, really good at their job of killing inflation, the data also suggests something else. Unfortunately, almost every single time they attempt it, they will put the US economy into a recession. There simply is no way of killing inflation without a recession. Our data shows us that we will go into a recession. Now, the good news is this. Yes, we're going to go into a recession that slows everything down. But the good news is this. When the Federal Reserve is trying to kill inflation in a strong economy, every time it's put the US economy into a recession like that, it's been a weak recession. So a small one, which usually lasts 6 months. So it doesn't really harm the economy. You get, a slowdown that happens. Inflation slows down, jobs slow down. There's a little bit of job loss, but it's pretty small. So once again, data is showing us what this path forward will look like, which is, we'll kill inflation. So it'll be painful. It's already been painful for us. We've had some challenges that I would have rather not had, like high interest rates. But over the next 6, maybe 9 months, may at the most 12 months, the Fed will kill inflation, will go into a 6-month recession, and will come out of it very quickly. And so here's the last part that our analytics tells us when it comes to inflation and high mortgage rates. In every single case where the Fed attacks the US economy to kill inflation, brings the US economy down, puts us into a recession, in every single case, once the economy goes into a recession, the Federal Reserve cuts interest rates. So the Fed's job is not just to bring the US economy to its knees, Yael. Its job is to pick us back up. So it brings us to our knees, make sure that inflation is dying, and then brings the economy back on its feet. And that's the process of cutting interest rates. So we see an extremely high likelihood of low interest rates in the United States, low mortgage rates in the United States 12 months from today. And so all of our going forward analytics are based on this. So we do see, home prices in the US falling potentially by 5% as we go through this process, go into recession, but we also see a quick recovery for home prices within the next 12 to 24 months. I think if you don't look at data, you're going to react negatively because there's a lot of fear. One of the nice things about data is it tells us all the bad things that are going to happen, and then you just simply deal with them. So the bad things that are going to happen is that we are going to continue seeing high interest rates for at least 9 months, maybe 12. And it's even likely that the rates will go up further, because one of the key things is a lot of people are like, yeah, the Fed's just going to stop raising. The answer is no. US economy is incredibly strong right now. We produced 500,000 jobs last month. In a normal month, normal time, we produce 200. So if you're producing 500,000 jobs, the economy is still very strong, which means the Fed still has a ways to go and will continue to raise interest rates, despite the fact that the world economy is weakening very fast. And a lot of that has to do with the Ukraine war. My predictions weren't correct, because I felt like at the beginning of the war that Ukraine would not be able to sustain a war longer than 30 to 60 days. So a lot of the base predictions were based on that. And what we've seen is, honestly, Russia has surprised in terms of their incompetence fighting this kind of a war. That the fact that Ukraine's still fighting today and still has an actual chance at winning, small chance, but still has a chance of winning the war, is interesting. Also, what surprised me is how organized the Western world has been in opposition to Russia in terms of both providing money and weaponry to Ukraine. So I think that a lot of my predictions didn't come true. Luckily, today we're in a much better place to kind of understand where things are going. So what does the war mean for the world economy? Well, it's terrible for hunger. We are seeing one ship leave Ukraine every 10 or 15 days, where there used to be 10 ships leaving per day. So economies in Africa, and it's horrible that tens of thousands of Ukrainians are dying, but I think we're about to see millions die in Africa because of food shortages. Keep in mind that the largest wheat producer in the world, Russia, is fighting the fifth largest wheat producer in the world, Ukraine. So I think the biggest impact to the world is simply world hunger. And you're going to see wheat prices have come down as people started to understand that there may still be some wheat coming out of the Ukraine. But I think they will go back up over the next 3 to 6 months. Oil prices have come down. Once again, I believe that oil prices will start to move upwards. And so obviously what this means for the US economy, some of that we did get right. And that was higher interest rates would happen. We're seeing those rates. I didn't really expect them to go up this much because the US economy is fighting the Fed. A lot of times what happens is when the Fed starts to threaten to raise rates, the economy sort of starts to shrink by itself because people are looking forward and saying, hey, a recession's coming. But the economy is fighting the Fed. It's still incredibly strong. Household, values are very strong. We haven't seen any actual declines in household prices, even though we expect those to happen in the future. So it's been very interesting. And I think that what really changed there is, firstly, we didn't expect the Ukrainians to put up such an incredible fight. And second, we didn't expect Russia to be so incompetent while fighting a war of this kind. At this point, we see a stalemate. We don't see Russia being being strong enough to push beyond the Donbass and get it towards Kiev. And so I think that war runs on for months and months on end. The effect on the United States, we've already felt it, right? So it was, the rising interest rates, the increase in the price of oil, and also the supply chain lines breaking. And so all of those are actually improving in the last 2 or 3 months. Well, I think that this is actually a terrific time to use technology to locate good investments, because oddly enough, in the last 6 or 7 years, if you were a monkey with a dartboard and that dartboard was the map of the United States, if you threw a dart and it hit anywhere on that board, you were fine. You made money. Everybody made money because it was very difficult to lose money in real estate in the last 7 or 8 years. And so a lot of people have moved away from data because, hey, it's just implementation. That's really, if you have strong implementation, you're going to do just fine. Well, that doesn't work in a sideways economy. So today we have a sideways economy. Some of the most strong markets in the US are actually the ones seeing early price decline. So Boise, Austin, Phoenix, right? These are superstar markets, Reno, right? That have seen astonishing increases in price, astonishing increases in profits. And those are the ones that are losing steam the most. So we're seeing the reverse of what happens in a typical US recession or pre-recession, which is the weak markets tend to weaken first. This time, the strong markets are weakening because they've gone up the most. So really what it comes down to is today, real estate is risky at this point in time because you truly don't know what's going to happen. At times of risk, the best way to invest is called fundamentals investing. And the best known fundamentals investor in the world is Warren Buffett. Warren Buffett says, I don't really care about momentum, where the market is going. I just focus on buying things that have true value and I want to buy them cheap, right? That's his stance. That's his focus. And so that's fundamentals investing is what you should be doing today. And technology incredibly helps with figuring out where the fundamentals are really, really strong. So we look at fundamentals all the time and we track them all the time. We currently track about 330 cities in the United States to see where the fundamentals are strengthening. So some of my favorite markets are actually weakening. So, markets in Texas are beginning to weaken. So is Denver, Colorado. Markets in Utah are weakening very, very quickly. So is Idaho. And so some of the markets that I am invested in that I'm doing well, I'm kind of late in the game there, are the ones that are actually getting weaker. And so when I'm looking at amongst the top markets, the ones that are not weakening, my data is showing me that Georgia, which has, Atlanta in there, and Florida, which basically is Miami, but also the west coast of Florida, is not weakening at all. So by looking at the data on a monthly basis, you can actually predict the future. You've got a crystal ball. And what we do is, and there's a course on Udemy that I've taught, there's about 10,000 students currently enrolled in the course. So if you type in udemy.com/Neal Bawa and hit enter, you can see the course. You'll notice that there's slightly over 10,000 people currently taking the course. And this course basically is this step-by-step real estate analytics process. Because I tell people, look, a lot of people that invest in real estate think they're data-driven. And it really depends on what is your definition of data-driven, right? If your definition of data-driven is every time you look at a city, every time you look at a neighborhood for investing, you're just checking, that there's job growth and population growth and income growth. Okay, fine. You're data driven. But are you doing analytics? The answer is no. That's not analytics. That's just you doing, good, high quality due diligence. What is analytics? Analytics is the process of taking all of these key metrics and some others. I'll give you the top 5 that we use, but there's many others, right? Job growth, home price growth, income growth, crime reduction, population growth, right? So these are 5 basic metrics. But analytics is the process of measuring these metrics and figuring out which one of these affects profits the most, which one of them is bigger than all of the other metrics, and then back testing it. So making a bunch of assumptions and then back testing them on 100 metros to see what came ahead. If you use job growth as your biggest metric and you back tested it on 100 cities, did you come out ahead? What about crime reduction? When you back tested that on 100 cities, did you come out ahead? Which one of these metrics really juices the profits? And how much of each metric should you use? That is analytics. That is data science or big data. And I don't really see anybody doing that. We do this every single month. And we even publish this information because I came from a big science, big data analytics perspective. So today I know that there's markets in the United States that nobody knows about, like Rogers, Arkansas, right? If you were to ask people to name the best states in the US to invest in, Arkansas wouldn't be in the list even if you asked for the top 20. And I don't like Arkansas. I don't like the state. But in the north of Arkansas is an area called Rogers, Arkansas. And that area, the data shows, is absolutely incredible. Then there's a corridor. We often don't look for cities to invest in. We look for corridors because often when corridors strengthen, everything in the corridor strengthens. So you don't necessarily buy in the most expensive part of the corridor. You buy 30, 40, 50, 80 miles away, and you make a huge amount of profit there. So the corridor that's strongest in the US right now starts in the city of Tampa in Florida. This is the western side of Florida, not the eastern side with the expensive Miami and Palm Beach piece. This is the western side of Florida. So it starts with Tampa and then goes down to Bradenton, then Sarasota, then Port Charlotte, Punta Gorda, Cape Coral, Fort Myers, and ends in Naples. And the corridor is about 200 miles long. So when we do analytics, and the course, by the way, shows you exactly what I'm talking about, because you're like, how does he actually do it? And the answer is, there's an hour-long course. Go take it. At the end of an hour, you'll be able to find any corridor in the US. You'll be able to compare any city in the US and any neighborhood in the US against any other city, and you'll know which ones are better, right? And really uses those 5 metrics, right? Population growth, job growth, income growth, home price growth, crime reduction. Those are the 5 big pieces. And today, it's critical you use these pieces because markets are slowing. There's a huge amount of risk when every single market in the United States, all 400 of them, are slowing at the same time. Wow. So it's absolutely critical to know which markets are not slowing or which ones are slowing the least. And you asked me this question about, how do you use it today? The short answer is you combine it with things like modular technology, right? What's the biggest problem today in the United States? We can't build enough homes. We can't build enough apartments, right? And it's a chicken and egg situation. If your labor cost is going completely crazy, there's not enough construction labor in the United States, then how do you fix this problem? Your prices are going up because you don't have enough homes. You can't build enough homes because you don't have enough labor. The only solution to that problem is technology. If you used modular construction and built your property in a factory, then instead of taking 12 months to build it on site, you can build it in 12 days. Right? And in the factory, you still need a bunch of workers, but those are factory workers. They're not construction labor. They're easier to find. Sure. Yeah, I think you took that from my LinkedIn. That I've written that before. I was like, I want to write a single sentence that covers all of my beliefs in one place. And that is that sentence. I've never had a podcast host actually go back and find that, but so kudos to you. We're at a turning point, right? So real estate is simply the largest industry in the world. The total value of all real estate in the world is $326 trillion, which is more than twice the size of the world stock market. So there's $326 trillion. That's $326,000 billion worth of real estate in the world. So you have this fundamental fact of, okay, here's the largest market in the world, but it's also the most backward market in the world. So if you look at any market in the world, any other market, airlines, insurance, anything else, manufacturing, you will really struggle to find a market that is as technology backward as real estate. And most markets have been disrupted. Manufacturing has been disrupted. We build iPhones, 8,000 miles away from where we use them. Those are perfect examples. Everybody knows those kinds of things, right? These markets are extraordinarily disrupted. But if you look at real estate has only been disrupted from the perspective of selling and buying real estate or raising equity for real estate. So we have perfect examples of disruption there, in terms of crowdfunding sites that can raise money to do that. And that's really well developed. And then, there's lots and lots of websites like Zillow that can help you buy a home or sell a home. So from that perspective, doing really well. But now you look at the perspective of, okay, how do you do things at a larger scale? I'm not talking about Yael selling her single family home. I'm talking about $100 million, $200 million, and billion-dollar projects. How do you quantify real estate? Just like you quantify stock, right? And that hasn't happened yet. And a lot of people are like, no, that really can't happen because real estate is all over the place. Well, manufacturing is all over the place. Do you manufacture everything in the world on one island? Maybe it's called Taiwan, but most of the time you manufacture it all across the United States, all across the world. So the truth is, every other industry that has been democratized, that has been disrupted, really had the same problems as real estate. It's spread all over the place. The product is different, yada, yada, yada. Real estate is not any special. It's just harder. Why? Number one is regulation. There's an incredibly large amount of regulation in real estate. And there's, millions of different sets of laws just in the United States. And obviously, worldwide, it's even worse. And second is that there is a lot of vested interests. I am part of that vested interest. You are part of that vested interest chain. So there's so many vested interests that it takes time to break through. So real estate is unquestionably being disrupted, but the piece that isn't disrupted yet is the most important piece, and that is true liquidity. Real estate is a completely illiquid asset class. And a lot of people are like, no, that's not true. I could sell my home in 30 days. We're talking about the biggest portion of the asset class, offices and multifamily and malls. You can't sell a mall in 30 days. It takes a year or maybe 2 years to sell a mall. We have a bunch of prop tech companies and a bunch of fintech companies and some companies that are both prop tech and fintech really coming together in various different ways, trying 1,000 different angles with the ultimate goal of creating liquidity. And that liquidity also means once you create that liquidity, you've 10x the number of investors that can invest into this asset class. And that just changes everything for real estate. My prediction is if we get to that tipping point of liquidity, that 326 trillion in real estate is going to double. It's going to become 700 trillion. I'm banking on it, right? This is that, I'm putting every resource I can towards that. Number one is I am investigating as many liquidity mechanisms as I can, right? So tokenization is one. A while back, I reached out to you and we spent quite a bit of time talking about the solid block, product and how we could use that. Then I go out and educate myself. I go to tokenization conferences. One of my friends actually tokenized the first multifamily in the United States. So I've learned from him. and I'm preparing my investors. So one of the key things is investors are afraid of tokenization. They're like, oh my God, blockchain lost, 40% of its value in 3 months. And it's like, no, 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 no. Your money, when it's tokenized, is still going into a physical property. That physical property hasn't lost one single penny of value, right? You're still you're using tokenization as a liquidity mechanism, but you're investing into real brick and mortar real estate. And it takes a while to explain to people why tokenization is really the best of both the digital world and the physical world, the physical asset. So that's what I'm doing right now. I'm continuously educating my investors as we wait for tipping point. I think it's going to happen country by country. So as you can imagine, you know this more than most people do. Some countries are ahead. The US, for example, is sort of behind because they have this process that they follow. The Securities and Exchange Commissions also sets severe restrictions on us. And those restrictions change. I mean, if you think about crowdfunding and where it's come from 2014, where it was the wild, wild west and nobody knew how to follow the law, to 8 years later today, it's pretty clear what the law is with crowdfunding, right? So it took about 7 or 8 years. Tokenization is maybe 3-4 years behind that. So it takes a little bit of time to go from the wild, wild west to get to the point where our SEC, our Treasury Department issues appropriate guidances. Also, there's steps forward and steps back. So the industry took a big step back when Luna and Terra and Celsius, just happened. So that's both a step back and 2 steps forward, and I'll tell you why. The step back was, oh my God, blockchain's losing a lot of value, all these bad things are happening, less, startups getting funded. So that's obviously what we've been feeling in the last few months since the collapse. The 2 steps forward, which I strongly welcome, is regulators finally saying, hey, we've got to regulate this. We've got to regulate blockchain, because the truth is tokenization is still a component of Web 3.0 and blockchain. And we need regulation. The wild, wild west is really not good for anybody else except for excitement. And so what I'm seeing now is big people in the US, at least in the US, talking about regulation. And with regulation, when there's a wave of regulation, there's also a wave of going out to the public and asking what they want, clarifying things, and then they loosen things up. It's just a step-by-step process. And so I think, to me, it's very regulatory here in the US, though I know that, other countries are ahead of us. Yeah, I think you're correct. India is a very interesting case. Because I'm Indian, I kind of understand some of the stuff there and I read about it. The Singaporeans are actually amazing at this kind of stuff. Singapore is Asia's financial center, especially now that Hong Kong's becoming less important with its China issues. So I think that you're going to see our regulators adopt some of the stuff that the Singaporeans have been successful with. That's what I'm seeing in the US. And I'm one of those people that is very interested in business ventures around investing in US real estate using non-US money. Obviously, the SEC puts a lot of roadblocks in our way, but it's something that I'm, very interested in and passionate about. There's people out there that have these bases in Asia that believe that there's scope for high-end product. One thing I know this really well is Asians like to invest in good-looking real estate. So my 30-year-old buildings may not be very sexy for Asians, but the ones that I'm building in the build-to-rent arena are the most gorgeous product, multifamily product in the United States. And I think that there's going to be a huge amount of interest there. I'm always, looking to welcome people that have these bases in either Dubai or in Singapore and countries like that, where we could collaborate, where we have the product and we can basically bring in additional equity. Finding me is really easy. I am the only Neal Bawa on the World Wide Web. So NEAL space BAWA, hit enter. If you're interested in build to rent, just type in Neal Bawa build to rent. If you're interested in how we outsource to the Philippines, because that's something that really helps every business. We teach you the techniques that we use to have a successful outsourcing team. You can type in Neal Bawa virtual assistants. You'll see about 40 or 50 podcasts there. And if you're interested in investing with me, if you're watching this, behind me is the logo of my company, Grocapitus. Just go to grocapitus.com and you'll see investment options. You can also, if you're not watching this on video, just go to grocapitus.com. If you're interested in our data, that is all stored at a different website, multifamilyu.com. So if you go to multifamilyu.com, You'll see roughly 26 webinars a year there where we share data. We do not charge for data. We don't, charge for subscriptions. We believe data is meant to be like Wikipedia. Give it away, give away as much of it as possible, and let the community take it and improve it. So even with our Location Magic course, it's recently been improved 3 times, and we didn't do any of those 3 improvements. Other people did.